the great thing about the market is not only has it always historically come back, it has always surpassed previous highs and gone even higher.
Yeah.
And we just need the time to allow that to work to be successful investors.
Peter, very good to see you. Welcome back, everyone. I'm excited about today's topic, 5 investing mistakes that you may be making right now. A lot of us wonder if we are doing all we can to achieve our financial goals. So today we're going to talk through 5 mistakes that you might be making and how to turn things around. So mistake number 1, getting out when the going gets tough.
Yeah, investing is a long-term game, and I know that people get emotional about their money.
Absolutely.
But you kind of got to just weather the storms and ride the ups and the downs. And especially if you are making contributions on an ongoing basis to that investment account, nobody likes losing money, but it is actually an advantage to have prices lower as you are buying in. It's the concept of dollar cost averaging. And I've got some great charts that show market returns when the money is changing direction. So if the account's just sitting there stagnant, here's what the market returned over the last 20 years. If, however, you were putting money in, here's your actual returns. And then if things change in retirement and you start removing money, the game changes completely. The direction of your money matters as much, if not more, than the direction of the market in your final results. So don't get too scared or quit when the going gets tough. I know you've got that chart that shows missing the best days of the market, which often happen right after the worst days. So the market goes down, people get scared and sell out, and then they miss some of the best days. And this chart shows the difference in missing the 10 best, the 40 best, or just staying invested for a period of time. And I think this one goes back, to 2006, Erin?
Yes.
There's another story. It's a pretty famous story that goes back several decades to the 80s of the unluckiest investor ever. And it's somebody who basically they finally get up the nerve to invest. They get some lump sum, they sell a house or they get an inheritance and they put it in, and inevitably, the day after they put that investment in are the worst days in the market over the last 4 decades. And they don't do anything other than get gun shy, scared, and not invest anymore because they said, well, last time I did it, I lost all my money. And they don't even pay attention to it. And then suddenly they open up their statement and there's millions of dollars there because they've let those dollars work and ride. Yeah, the day after they invested was a bad day, but the majority of days thereafter weren't bad, and the market's up over time. So the great thing about the market is not only has it always historically come back, it has always surpassed previous highs and gone even higher. And we just need the time to allow that to work to be successful investors.
Next mistake is taking on too much or too little risk.
Yeah, either side of the extremes here can be dangerous. It's a Goldilocks scenario, not too much, not too little, just right. And that just right is a little different for everyone. You've got to find what you're comfortable with. But the way that you become more comfortable taking risk is actually with what you do outside of risk. It's how you cover your budget and expenses and having a reliable stream of income that allows you the ability to invest a little of that income on an ongoing basis. The investment is not supporting you or determining your standard of living and your lifestyle. That's what the income and the paycheck, your sweat equity and showing up to work is doing. Your work, your paycheck supports your lifestyle and your ability to invest. And because it does not impact your lifestyle, if the market goes down, so long as you're secure in your income, hopefully you can feel a little bit more comfortable edging up and taking a little bit more risk. I've seen investors and retirees for several decades now. It was funny how the old adage was that younger people should be more aggressively invested, and as you get closer to retirement, a little more conservative. And then after some of the big recessions, like the Great Recession, what I was seeing is that older people had experienced that before. That was just kind of par for the course. They understood what came along with investing. And younger people were remarkably risk adverse. They were gun shy because that was their experience investing. And then over time, over the years, I've seen that sort of ebb and flow back the other direction
Right.
the way it should. But your recency bias and what you've experienced has a lot to do with this as well.
Yes. And one way you may be taking on too much risk and not even know it. This is our next mistake. Talk about the risk that comes with not rebalancing your portfolio regularly.
Yeah, well, if the market is doing well, then that side, the risk side of your portfolio, is growing more than the safer side. So let's just say that somebody had a risk tolerance level that said, hey, with my investment money, with my available dollars, I'm comfortable being about half in the stock market, but half of it, I want something more fixed interest, fixed income, a little more steady as we go. And then the market does very well for a period of 5 or 10 years. Well, that would mean that that side of the portfolio probably grew more than the fixed interest side. So now not only have 5 or 10 years passed and theoretically we're that much closer to retirement, we should have a little less risk, but because the market has done well, now we've got more in the equities side than we even started with to begin with. So rebalancing regularly is important, but it's also, it's again, that Goldilocks scenario, not too little, not too much. You don't want to be rebalancing every day because then you're taking away the ability for those dollars to work for you. I would say that as you progress in your career from your 20s to 30s to 40s, rebalancing, not all that important periodically, maybe once every 5 to 10 years, but set a good allocation, pick some good funds. And for the long-term investment mentality mindset approach, you let those work and you let those go. As you get into your 45, 50, 55 and closer to retirement, rebalancing more often and more accurately does become more important. We really need to maybe bring that into once every other year. And then as we get into the home stretch, once a year, maybe even quarterly. Don't overdo it. Don't underdo it. Don't just set it on cruise control and go in the back and take a nap. Right. This is not a auto self-driving feature. And even if it was, you still want to be paying attention.
All right. Next mistake is paying too much in taxes. And Peter, I think a lot of people will hear that and think of a calendar year or when they're filing their taxes, as opposed to what you and I are talking about, which is over your lifetime.
Yeah. And many of us are going to end up overpaying on what is already our largest known expense over our lifetimes. Taxes are one of the biggest expenses that we'll have, one of the largest line items, especially in retirement. We get to retirement, we've got a finite amount of money, a limited lump sum, and an unknown amount of time to make that money last. And then we've got to account for the IRS out of that. And a lot of people have specifically set up their retirement. They've been saving in such a way to result in the highest tax bill possible once they are retired. And right now is the time to manage that. Now's the time to understand that, to really look at it, to crunch the numbers, and to begin to handle that lifetime tax liability that you've got sitting there in your 401ks or your IRAs or your retirement accounts. And, there's different perspectives on this one from different professionals, Erin, because if you go to a tax preparer, their job is to look back at last year and try to save you the most amount of money on what's already happened, which is a valuable job. Like that is an important thing to do. Save as much as we can on last year. But oftentimes that is in direct conflict and opposition. That is counterproductive to the goal of saving as much as possible into future years. And so we've got to reconcile that difference as well.
And now our last mistake, not seeking professional advice when you need it. So ask yourself these 3 questions. Do I have the skills to do this? Do I have the time to do this? Do I want to do this? And if the answer is no to any one of those questions, you probably want to ask for help.
Yeah. And shameless self-promotion here and self-interest. I think most people would benefit from having an advisor, but I think those questions that you ask are very important. Do I've got the time? Do I have the knowledge? Do I want to do this? And I've heard a couple different analogies here. One on the extreme of, I could maybe pull my own tooth. Do I really want to be my own dentist or surgeon? Toning that down just a little, like I know how to change my own oil. I am capable of doing that. Is it just worth it to have somebody else do it? Not only because I don't have to clean up the mess, but actually several occasions that person underneath the car was like, hey, this is happening underneath your car. You may not know it now, but it's a potential problem down the road. They've got an eye that's trained to spot and identify things that maybe I wouldn't even know to look for. And I think that is really kind of bringing the analogy full circle. The true value of an advisor, they're not just doing this once for the very first time and winging it. They have seen it over and over and over again. They've studied, they've got tests, they've got credentials, they've got continuing education, and they see the real life, real world scenarios to maybe help you spot and identify things that you would not have seen otherwise. And we, it's what we don't know that can hurt us. It's those things that we've missed or think that we might have missed that keep us up at night. So just a quality of life, like having somebody to bounce ideas off of, or just handle the whole thing if you don't really want to, if that's not your bailiwick, is very beneficial to many people.
Yeah, peace of mind, right? Yep. Even if you bring your plan to somebody and they say, yeah, you're on the right track, then you can.
Everything looks good. Or, hey, have you thought about this or that you may want to consider?
Right. Well, Peter, then if somebody would like to talk through this with you, get just a second opinion on anything with how they're invested, what's the best way to reach you?
Give me a call, 919-300-5886. We do offer to put together, for anyone listening to the program, gives us a call. We'll put together with you, for you, your own custom optimized retirement plan. And that looks at income, investments, taxes, healthcare, legacy. A lot of mistakes have been cited. A lot of pats on the back have been given, right? You're doing everything right. Everything looks good. Congratulations. You're doing good planning is part of that process. And then other times it's, hey, we really need to do some work here to get you into better shape. Either way, the benefit of knowing that is I think, reassuring to folks. So give me a call. We'll run through it. Again, no cost, no obligation. Leave the checkbook at home. 919-300-5886. 919-300-5886. You can also visit richonplanning.com is what it looks like. richonplanning.com.
All right, Peter, thank you.
Thank you. Yeah, appreciate it. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. One of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookzone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.